Now let's look at how the inflation and unemployment dynamics affect the Federal Reserve's ability to maintain a stable inflation rate. In fact, what we're going to see is it's the credibility of a nation's central bank that affects inflation. Let's suppose we were at equilibrium here at point C with aggregate supply 0, aggregate demand 0, and output equals potential output. And for some reason, the aggregate supply curve shifts back. This could be for a number of reasons. There's some sort of adverse supply shock that shifts the aggregate supply curve to AS1. Now we've got an equilibrium here, a short-run equilibrium, with output less than potential output. Under these circumstances, we've got a recession, and we need to decide what to do as policymakers. If policymakers decide to do active monetary policy from the central bank, we could shift the aggregate demand curve out and get to equilibrium at point B, eliminating the recession but driving prices up. Alternatively, the Federal Reserve could decide to do nothing, keep aggregate demand curve constant, and allow the economy to take care of itself and get back to point C. And we talked about this when we looked at the transition from the short run to the long run. And the difference was how long we might think this takes. And so if policymakers think the natural adjustment is very fast, probably going to let the aggregate supply curve shift back down and the natural dynamics of the macroeconomy. If policymakers think it's going to be very slow, probably going to have active policy. Now the interesting part comes if the Federal Reserve or any central bank has made a commitment to keep inflation steady and price level not rising very fast, then that credibility might require the Federal Reserve to do nothing and allow the price level to go back down and us to reach this equilibrium at point C again. If the Federal Reserve doesn't stick by its commitment to keep stable inflation and is accommodating, in other words, allows aggregate demand to rise or drives aggregate demand up to get rid of the recession and thus increasing prices, well, the lack of credibility is going to affect people's expectations. When people start to expect that the Fed is going to be accommodating of this supply shock, that increases expected inflation and thus raises the inflation rate around the economy. When we look at central bank behavior and inflation rates, we can try to get an idea of how much credibility impacts inflation rates. Let's look at a scatter diagram of central bank independence and inflation rates. And we might think that a more independent central bank, one that is less susceptible to political pressure, would be less likely to have inflation because they can make harder choices and allow an economy to stay in a recession longer and allow it to adjust automatically with lower inflation rates. And in fact, when we look around the world, we can see that when we plot central bank independence, more independent central banks tend to have lower inflation rates.